The 1992 securities scandal, with Harshad Mehta at its center, has captured the public's imagination again thanks to the popular web series Scam 1992. While the series did a fantastic job, it barely scratched the surface of the scandal's intricacies. Today, let's dive deeper into what really happened. At its core, the 1992 scam revolved around stockbrokers seeking funds to invest in the market. RBI regulations made it difficult for them to borrow from banks, but they found a way around it. By trading government securities, brokers colluded with banks to access funds and pump them into the stock market, driving up the BSE Sensex by nearly 4 times between April 1991 and May 1992. Stockbrokers, like Harshad Mehta, needed funds to finance their trades and found a lucrative loophole. They exploited banks' need to comply with RBI's cash reserve ratio, CRR, and statutory liquidity ratio, SLR, by engaging in ready-forward deals. Essentially, banks would sell securities for cash and agree to buy them back at a higher price, thus bypassing the cap on interest rates. A key element in the scam was the misuse of bank receipts, BRs. These were supposed to be temporary placeholders until actual securities were transferred. However, banks began issuing BRs without holding the underlying securities, turning BRs into a form of currency that represented non-existent securities. Despite RBI's efforts to curb these practices, banks and brokers continued their illicit activities. The brokers accessed vast amounts of money, funneled through banks in the guise of ready-forward transactions. Harshad Mehta, in particular, became notorious for his role, leveraging these funds to manipulate stock prices through his replacement cost theory, valuing a company's stock at the cost required to build a similar capacity from scratch. The situation began to unravel when RBI inspections in January 1992 revealed significant shortfalls in the bank's portfolios. The turning point came in April, when the RBI found a massive shortfall in SBI's investment portfolio, exposing that the bank had paid Harshad Mehta without receiving the securities in return. Harshad's manipulation led to a dramatic stock market rally, which collapsed once the scam was exposed. The BSE Sensex, which had soared to 4,467, plummeted below 2,600 by August. The Jana Kiraman committee later estimated the scam size at 4,024 rupees crore, based on exposures of major financial institutions that ended up with nothing but forged securities and empty BRs. Harshad Mehta's arrest and the subsequent crackdown on the illicit dealings marked a significant turning point in India's financial regulations. The scandal not only shook the stock market, but also led to profound changes in the financial sector, aiming to prevent such manipulations in the future. The 1992 securities scam remains a landmark case in Indian financial history, a story of ambition, greed, and the dramatic downfall of one of the most influential brokers of the time.